Well, cooler than expected US inflation figures provided a welcome relief to the FOMC last week, although Chair Powell and co continued to seek additional confidence before delivering that first rate cut. Nonetheless, equities on Wall Street continue to gain ground with record highs for the S&P 500 and the Nasdaq as treasuries and the dollar also firm, although the story is somewhat different here in Europe, where political events continue to dominate market participants' minds. It's a somewhat quieter data docket ahead this week, although we do have 4 G10 central bank decisions, plus inflation figures from here in the UK and retail sales from the United States, which should give markets more than enough to digest as we move through the next 4 trading days. Plenty, as always, to discuss on the trade-off this week. Without further ado, let's crack on with the show. So a busy week for markets last week, a slightly quieter week ahead this week. But of course, we do have not just markets, but also the football to get our teeth into as well. England starting with a business-like but perhaps uninspiring performance over the weekend. And actually, those are 2 words that we could use to describe my co-host, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good morning to you. How are you doing?
Good morning, mate. At words indeed at the moment. It's been a job's done. I think first game, get the 3 points under the belt, get the win, and move on to the next game.
Absolutely, and let's hope that winning run continues. In any case, we do have a ton of things to get our teeth into on the show this week, so let's get into Topical Thunder. So plenty to discuss. I want to take a very brief look back at last week, first of all, because we had a couple of key events over in the United States. Of course, the CPI figures, the main market focus last week, and the May inflation data coming in a little bit cooler than expected. Headline CPI flat on a month-on-month basis, down from the 0.3% rise that we saw in April. That is the first time, actually, that headline CPI has been flat since all the way back in October of 2023. We also saw continued disinflation at the core level, with core prices rising just 0.2% on the month, down from 0.3 in the month prior. And when we move that out to the annual level, headline inflation printing at 3.3%, down 0.1 percentage points from where we were in the prior month. And the core number coming in at its lowest in more than 3 years at 3.4% compared to a 3.6% previous. Now that, to me, and I know Brian may disagree with that one, is clear signs that the US economy is continuing to make progress on disinflation. It helps to support the idea that the cooler than expected figures we saw in April weren't just a one-off, and that actually the US economy is now on a more decisive, albeit still bumpy, path back towards that 2% target. Although, as I said in the introduction to the show, that data is still not yet enough for the FOMC to deliver that first rate cut. Policymakers are looking to be confident that that data is a trend and they won't overreact to one data point, as we always say, and so it has proven, with Powell and co really repeating their guidance last week, keeping the Fed funds rate unchanged, of course, but repeating that they continue to seek confidence that inflation is returning towards that 2% target before they do indeed begin to normalize policy. What was perhaps most interesting, though, out of the FOMC meeting last week was the latest summary of economic projections, a modest rise to the inflation profile over the next couple of years, and that in turn resulting in quite a substantial hawkish revision to the dot plot, with the median 2024 dot now pointing to just 1 25 basis point cut this year compared to the 3 that were implied by the March dot plots. Although it's still worth mentioning that 8 of the 19 members who put their little dot on that projection on the form still see 2 25 basis point rate cuts this year. So the dot's very, very finely balanced indeed. And if you listen to what Chair Powell said in the press conference, the framework and the reaction function remains the same. The FOMC have a desire to cut still, either with it having obtained confidence on inflation or as a response to unexpected labour market weakness. Personally, I think they're going to go in September. Ryan, are you later than that, or are you coming round to my slightly more dovish view at this stage?
Well, they've been wanting to cut for the last 6 to 8 months, and they're still not there. They still haven't got confidence yet. The CPI came down, the core came down. That's continuing its trend, but it's snail's pace at the moment. It dropped a couple of pips over the prior number, but still well above 3%. the headline number. That's now 12 months coming in above 3%. And, that's sort of my pivot level for when cuts really come onto the table. If you get a 2 handle on the numbers, then you're on your way. So there's no change for me. The Fed still struggling to get that confidence, as you say, to actually put a cut on the table and give us a clear date. And they're worried about it. And it's okay for them to sound a bit more, I wouldn't say hawkish, but undovish, because they don't want to get caught up.
Sorry, what?
Undovish.
Making this up as he goes along now.
Well, there is a difference. People think that if they're not dovish, they must be hawkish, and that's the wrong distinction. I like to have my little bits in the middle. So undovish and unhawkish.
I think in the common central banking vernacular, we would call that neutral. But unhawkish or undovish or whatever you called it, that works, I suppose.
Yeah, it works for me, so I'm using it. So you can do what you like with it, mate. But yeah, so they haven't got that confidence. And it's difficult, as I say, they don't want to get caught out. I mean, this inflation drop's coming on the back of a couple of big rises, where inflation got down to sort of 3.1, 3.2, and then started going back up again. So they might have broken that move, but it's still going sideways. And yes, people point to PCE and the like, but this data is the one we reacted to. And then the dot move, probably with that CPI number, the market wouldn't have really been looking for one cut for 2024, but they got that. So that was a little more of a hawkish line. But it doesn't matter, because they'd rather protect the upside risk to inflation and make sure they've got that covered so they can hike if necessary. But they don't need to be in a rush to cut still. And I think, as I say, we've played this game all year. When are they going to cut? When are they going to cut? And I don't think we're any closer to a cut. Maybe by a couple of steps over the course of a mile. But apart from that, yeah, we're no real closer to knowing.
No, I think you're right. And I think the other thing to remember is the Fed are data dependent, markets are data dependent. It is almost impossible to gauge and guess and second guess the timing of that cut. And actually, something I've been saying for most of the year is it doesn't really matter, whether it was March, whether it was June, July, September, December. The fact is, particularly for risk, the Fed want to cut. The Fed can cut if they want to. If the data tells them that they need to cut, then they can and they will do so. And that, I think, is what continues to provide a very, very supportive backdrop for risk assets, as I know we've discussed at some length. And unless and until the Fed stance changes on that, which I don't think it's going to, then that Fed put remains firstly very flexible, but secondly very forceful. And certainly I wouldn't want to be playing equities from the short side at the moment. But anyway, we can discuss that a little bit later on. We've got a very, very busy week ahead, haven't we, mate?
Yeah, very much so. As you said, it's a bit quiet on the data front, but we do have some key moments. We're over the bulk of most of the central banks, though, as you mentioned, we still have a few to go. BOE and SMB among two of those. So we're back now to data watching, and that will affect, and how that data is going to affect the recent guidance from all these banks. So I'm going to go through some of the data points, some of the key data points we got this week. We need to keep an eye on for that. On Tuesday, we get May retail sales, which will be the real first-tier data we've had since the FOMC. They're expected up a marginal 0.3% from a flat April. Wednesday is going to be really important for the UK and the Bank of England, because we have that CPI data coming a day before the BOE meeting, and I'm sure we're going to go over the numbers in the Bank of England topic. Thursday, we have the SMB and the BOE. Later on the US, we have the May housing starts and permit numbers. Now, starts is one area of the US economy that might be waving one of those small yellow flags, as we missed to the downside for the last two readings, and we saw quite a strong downward revision to March last month. Permits have been a bit steadier, but it's groundbreaking, that's what the starts are, which is a bit more important in this data, because it's all right having a permit, but until you start the work, that's the main important thing. Then on Friday, we get Japanese CPI for May, and that's going to be very important to put the Bank of Japan to the test again. They've largely brushed off this weak Q1 data, so the May data really needs to start going their way for them to keep on this tightening path, or else we could see the yen flying quite significantly. Now, these numbers are the national numbers. We had the Tokyo numbers ahead of that, which saw a rise in CPI. The core is expecting to jump in this one to 2.6%,
Indeed, yes, PMIs, what joy. I think you've covered that brilliantly, mate. I don't really have too much to add. The only thing I would say is your point on retail sales, both here in the UK and in the United States, perhaps more so here in the UK. If we're hoping for good weather to boost retail sales, then we may as well also hope for pigs to fly. I mean, it's mid-June and I'm dressed like I was in this studio in November and December last year. It's ridiculous. But anyway, the data is very, very volatile. And I think markets are prone naturally to overreact to these prints as and when they come in, particularly if there is a big deviation from forecasts. But I think the thing to bear in mind from a policy perspective is twofold. Firstly, barring the inflation figures that we've got here in the UK and that we also get from Japan on Friday morning, I don't think any of these prints are going to have too significant an impact on the policy outlook, because policymakers continue to focus primarily on inflation rather than on the labour market or on the growth side of the economy. And I think the second thing to bear in mind is that, just to repeat what I said earlier, policymakers certainly aren't going to react to one significant data point, be it a miss. They watch trends in the data rather than just a one-off point. So plenty for markets to get their teeth into, perhaps some knee-jerk moves and some short-term vol, but I don't see much of this, perhaps the PMIs being an exception, changing the bigger picture of what we see at the minute.
No, I think you're right, but trends is the key word there. And like I mentioned with the housing starts, we've had 2 lower months now and a really, stinky downward revision. So, it's these small yellow flags and they keep popping up here and there. The PMIs, they've been negative for manufacturing for a lot of countries, but that negativity has been improving, month by month in small parts. So again, there's a little trend of improvement there. Is it going to maintain and we start to see some going into expansion, or are they going to stay negative? And then we get the knock-ons in all the other assets like commodities and whatnot. So trend is definitely what we need to be looking out for in the data.
Yes, indeed. Well, in any case, it is a big week here in the UK this week. We've got the latest inflation figures due up on Wednesday, tomorrow morning. And then, of course, we hear from the Bank of England on Thursday. Headline CPI is expected at 2% on an annual basis in May. Of course, that's down from the upside surprise, the 2.3% figure that we saw in the month of April, while core CPI is expected to notch a chunky fall as well, down to 3.5% from 3.9% previously. And of course, if that headline CPI print was in line with expectations, it would represent the first time that headline CPI has achieved the BOE's target since all the way back in July of 2021, which feels like a hell of a long time ago at this stage. Nevertheless, clearly some signs of stickiness and stubborn prices remain. The BOE obviously focused quite heavily on signs of underlying inflation and of inflation persistence. We know that policymakers like to place a lot of weight on services CPI, and that is expected at 5.5%, down from 5.9% previously, also, of course, in the month of May. So that would be a chunky decline, but it would still be, almost 3 times the BOE's target. So not something worth celebrating too much. Speaking of the BOE, whatever inflation figures come out on Wednesday morning, however that data looks, I don't think it's going to impact the BOE's decision on Thursday lunchtime too much. Of course, previously we had sat here and said, or I had sat here and said at least, that June is likely to be the start of the easing cycle, the BOE going to deliver the first rate cut. Well, that's probably not not going to happen at this point. And I think there's two, perhaps even three reasons why that is not going to happen. Firstly, obviously, we had that upside surprise to the inflation figures in April. Secondly, we had a relatively mixed labour market report last week. Earnings pressures are certainly not going away in the UK jobs market, despite unemployment rising quite substantially to 4.4%. And perhaps the biggest reason is that we are slap bang in the middle of a general election campaign. And of course, we haven't actually had any BOE speeches since all the way back on the 20th of May. And I think the BOE are likely to be loath to deliver the first rate cut when we are, exactly 2 weeks away from polling day here in the UK. So bank rates should remain unchanged at 5.25%. It should be a 7-2 vote once more, with Dingra and Ramsden dissenting in favour of a 25 basis point rate cut. And I think the guidance is likely to be pretty much a copy and paste of what they delivered back in May as well, saying that they are going to keep under review how long rates should remain on hold and maintaining that focus on signs of inflation persistence. Nevertheless, I think in terms of a trading opportunity or a trading risk to manage this week, I think the inflation figures are the ones that market participants should have their eye on, particularly as the OAS curve prices a negligible 2 or 3% chance of the BOE doing anything at all at the meeting on Thursday. If we were to get a cooler than expected CPI print, then you could see a little bit of vol in the OAS and in the rates market, and you would expect that perhaps to filter through into the pound. Although, as I said, I don't think no matter how big a surprise we get on that CPI figure on Wednesday morning, I really don't see the BOE doing anything at all of interest on Thursday lunchtime.
I'm glad we record these so I can refer back to it when they cut 50 basis points on Thursday.
That would be bloody typical, wouldn't it? The Bank of England, it would just sum it up.
I mean, we talk about the Bank of England for months and months, and it really is a mess. I was an August man for a long time, but we know that they're desperate to cut, really desperate to cut. And if we see a headline CPI number less than 2%, I think we're going to be at 80% chance of them cutting on Thursday, particularly if the cores may be down, 3.1, 3.2%, because they are that desperate. And if inflation is under 2%, that puts them under target. Okay, and now they're in a position where they might be seeing inflation accelerating to the downside, if you like, and then at risk of going the other way. So they don't want to then be in a right pickle where they're now trying to cut desperately to stop inflation from falling all the way back down to 1% or something. So with the Bank of England, you've got to match up what they should do, and what they should do is probably wait until August versus what they want to do and what they might do because they're stupid enough to do it. So I think the CPI data, like you said, is really important. But if it gets down to 2% or under 2%, I think there is a really strong chance of them hitting the button on a cut, because they could make it a bit like the ECB and the other central banks. Right, we've made the move, we're on the way, now we can sit back a bit, we don't have to rush. This isn't have to be a cut cycle where we cut every month, but we've got the ball rolling, and it's not really going to affect anything. And you say, we've got the election, but they're in charge of monetary policy. Whether if inflation went to 0% next on Wednesday, they'll cut rates because that's what they need to do, irrespective of an election. So I think they'll put that to the side. But it's at the very, very least, with the data we've got at the moment, and unless inflation shows a higher number, like we go back to 2.4%, let's say, in the headline, at the very least, I think we'll get something like a 5-4 vote that will then tee up a cut in August, because they'll want to signal that we're one vote away from cutting and give the market that signal. So that's what I think at the very least. But softer inflation under 2%, core nearer 3%, I think there's a really good chance they go.
Crikey. Well, it's very rare that Ryan is offering a more dovish outlook than I, so frame that one. If indeed that does pan out, then, look out below for the pound, I think, because that is certainly not something that the market is discounting at the moment, not even that very, very dovish vote split, and let alone the idea of a rate cut. In any case, let's move on to everyone's favourite subject, Ryan.
Yes, we're going to talk about politics. I know you love talking about politics.
Oh,
I might do it every week now until we get all these elections out of the way. And We're going to talk about Macron and his big gamble at the moment, which is looking a bit in the mix and a bit messy. The reverberations from the EU elections are continuing to play out in Europe. And as I said, all eyes are on France right now. And when these EU results started showing a big swing to the right and far right parties, we saw the Belgian Prime Minister resigning, Macron calling that general election, that snap election. And that was a huge gamble, as he was basically saying to voters, who perhaps use those elections as a bit of a protest vote, go on then, vote that way in a real election. And while he might have thought that was smart on paper, the politics in France since then has really moved against him. Now, it has to be said that he and his party weren't in the strongest position anyway. So this was also maybe a bit of an attempt to try and solidify his party now rather than waiting for the next big elections in 2027. But last week there was a poll out that had him coming in third behind a new left-wing alliance. A lot of parties have got together to combat this right-wing move from the left. And also we got the far-right party, Le Pen's RN party, which now is favourite, came first in the polls. So if this prospect of a right-wing majority government is really something that the Euro is starting to take note of now in a negative way. And if Le Pen gets into the hot seat, the market will be watching really closely to see if she's going to keep her hard right stance, or perhaps she starts watering it down a bit, much like Meloni did in Italy. Now, when we had this potential swing risk in France last time, markets naturally got nervous, but didn't think Macron would lose overall. And so it didn't really overreact during that time. But this time, I think the risk is real, and the knock-on implications for other countries and the EU is huge. And if it continues to look like Macron and his party are going to fall into the minority government here, the Euro could be set for really a big move south.
Yes, indeed. I mean, we're going to get on to, or I'm going to discuss the euro in a second, so I won't dwell on that for too long now. But I mean, what is it at the moment with leaders wanting to commit effectively political suicide? I mean, Rishi Sunak did it 3 weeks ago here in the UK, 20 odd points behind in the polls. Oh, I know, let's have an election. And now Emmanuel Macron seems to have looked across the channel and gone, oh, you know what, I fancy a bit of that and I'll do the same thing. I mean, it's just bizarre. The only thing I can think of from a political perspective, and this is a much more longer running theme, it's not a tradable story at the moment, is Macron has one eye on the 2027 presidential election. Now, of course, Macron cannot stand in that election because he will be term limited under the French constitution. But I think he's almost taking the view of, as you said, we'll have an election now, put your money where your mouth is, effectively voters. If this is who you support, then let's have them as a majority or the largest party in the National Assembly. But then almost use that as an effective stick to beat the National Rally and Le Pen with come 2027, saying, they have been in charge of domestic matters in France, because, of course, Macron is not going anywhere at this point. They've been in charge of domestic matters in France. They've been running the country for the last 3 years. Look what the country looks like. Do you want this to continue? And that effectively then becomes the 2027 election campaign. So that's an interesting one to sort of mull over the longer term. I think the other thing, just very, very quickly, and again, relating this back to the UK, is, as you mentioned, the EU elections. We did see this big move rightwards across Europe, be it France, Germany, the Netherlands, Italy, Austria, wherever. It comes at an interesting time because, of course, you're seeing a similar thing in the United States. Donald Trump looks likely to come back as president come November. But, of course, where is the one country where this move rightwards does not appear to be happening? Here in the UK. We're probably going to see a Labour government elected on the 4th of July with one of, if not the biggest, parliamentary majorities in recent times. And I think that's perhaps just another one to reflect on for the political scientists out there. Drop a comment below. Why on earth do we think that's happening?
No, that's a fair point. But then we don't really have any, prominent far right parties. A lot of people try to poke the finger at Reform, saying they're far right, but they're right, but not as far as some of these parties. But then I'd ask the question, if we were still in Europe, how would the UK people be voting in that election? Because it is a bit of, as I say, it is a bit of a protest vote. It doesn't really count for anything. MEPs don't, really enact policy over there. They, it's all done by committee, and then they all vote at the end of it. So you always have a ton of parties that might be prevalent in the European Parliament, but have no real grasp or no real foothold in domestic politics. But that's why the market's a little bit more active in looking at this one, because the RM party is a big party in France, and by the end of first week in July, they could be in government.
Yeah, absolutely. And you're right. That is why the market cares. I mean, if you'd have asked me a day before the EU election, I'd go, no, who cares? The reason the market now cares is because it's had that reverberation into domestic politics and in the Eurozone's second biggest economy, I think France is. Anyway, let's move on, because I want to discuss that in a little bit more detail in That's the Setup. So I want to stick with the euro. This is a very euro-heavy segment and euro-heavy show. And what I want to look at is spreads. Now, of course, anyone who has ever traded the euro from a macro perspective will be very, very familiar with the idea of core periphery spreads within the eurozone. And at this point, I think core equals Germany, periphery equals everything else. And wider spreads have always been very, very grim news indeed for the euro, because it is a sign, it is a symptom that the market is pricing in what we would term fragmentation risk within the bloc. And that encompasses a number of things. It encompasses, of course, the transmission of monetary policy. It encompasses the ability of individual member states within the Eurozone to actually borrow within the financial markets. And of course, the big one, which is that the whole thing could break apart if one of the members leaves. Now, that latter prospect seems pretty remote at the moment. Even Le Pen has sort of stopped beating the drum on that cause quite some time ago. But it nonetheless, the market is not going to stop pricing and not going to stop worrying about this risk until we have some clarity on the results of the election. And of course, that must come with the caveat that markets are notoriously dismal at accurately and adeptly pricing any sort of political or geopolitical risk. We naturally go to the worst case scenario. And that's exactly what's happened here. And it's happened to the degree where spreads have blown out so much that they've even been cut off the top of my chart there. Now, what am I saying here? Firstly, the ECB don't seem particularly bothered. We heard from Lagarde, Lane, de Guindos yesterday, all saying that this is a relatively orderly repricing. So the bar for the central bank to step in seems a very, very high one. But nonetheless, I think further spread widening could be on the cards here, particularly if polls do not shift, and particularly if the first round election results do point to the National Rally gaining a significant foothold in the Legislative Assembly of France. And as a result, I think headwinds facing the euro are likely to remain relatively stiff, and actually the path of least resistance, at least over the short term, for the common currency should continue pointing to the downside.
Yeah, I think you're right. And it's a bit strange that obviously we look at everything versus the Germans, but they didn't do so well in those EU elections either. So I'm not sure if it's out of the frying pan into the fire if you're moving between those countries. But yeah, the indications, as you say, are right for the risk that's involved with this now, and traders want a premium in these assets. I think it's really difficult. I would side with the fact that Le Pen will probably water, some of the really harsh, policies down, and it's going to be a case where I don't think we're looking at anything close to, France looking to exit or anything like that. It's all going to be likely about immigration and whatnot. So I can see this passing once we're through that election. We'll probably get a knee jerk if her party does become the majority government. The market's always worried. We've seen that from the Mexican elections, from the South African elections. You have the election, you react to that, and then the market says, well, what is actually going to come next? Is this going to be bad for investors? Is this going to be bad domestically for policy? So we're going to have that uncertain period probably for a few weeks after until we get the full list of potential policy changes. But yeah, I think if we start to get to extreme levels, you're going to get the bargain hunters then coming into the market and saying, well, this has gone too far. It's not the end of the eurozone, and that's when we probably see a top in moves like this.
Yes, very much agree. But of course, remember, as Lagarde said 4 years ago, it's not her job to close spreads, is it? What a famous blunder that one was all the way back during the height of the COVID crisis. In any case, let's stick with the euro and have a look at Euro Swissy.
Yep, going to look at Euro Swiss because we do have the SMB meeting, and I'm smelling potential for a bit of an opportunity here. The meeting is a bit of a coin toss for me. Roughly 66% of economists expect another 25 basis point cut from those guys. Remember, they do only meet quarterly. Now, while the market is also pricing about a 75% chance of a cut too. However, CPI has really bounced up from the 1% we saw in March to 1.4%, and it stayed there for both April and May. And there's been a bit of an improvement in the economy too, which prompted Central Bank Governor Thomas Jordan to come out and warn that the small upside risk to inflation, if it was realised, that would mean that their monetary policy stance was maybe a bit more accommodative than intended. So that would lower the chances of a rate cut at this meeting with those inflation numbers where they are. So for Euro Swiss, there's two real risks here. The first is that they don't cut as expected, which should mean some downside for the pair. The second is that with the euro under this cosh from the France mess, if they do cut and we see the Swiss selling off, so Euro Swiss rising, that might be a rally that will be very tempting for Euro sellers. Now, on the tech front, a lot of the tech is focused around the big figures at the moment. We've bounced from the 61.8 fib of the 2024 rally down to that was close to 0.95. We found resistance into the big figure around 0.96 after that break. And then we've got up into the 0.97 area. That was a big resistance level last year. And while we gapped below it last week on the EU election news, we couldn't retest that level on a bounce, even when we closed that gap. So the numbers really are centered, as I say, around those big figures. So for me, if the S&P do cut and we rally to that 96, 90, 97 area, I'll be looking for a potential short on these further, Euro, French, EU political worries. So I'm looking at shorts in this one and seeing if the S&P do me a favour.
Yeah, I think Euro Swiss is a really interesting one. I mean, as you can see, that move or the rally in the Swiss started a fortnight or so ago, and then has just really gathered some pace as we've seen European haven demand creep into the market. I think the SNB is the big one. My hunch is that they are going to deliver a rate cut. I think the market obviously prices that, so it's the option of least resistance for them. But I think also the fact that they only meet quarterly means that they are going to want to, as much as they can, I would imagine they want to keep pace with the ECB. And certainly the guidance that we've heard from policymakers there hasn't been particularly hawkish of late. So I like the levels you put on the chart. I think the SNB are going to deliver that rate cut, and then further downside if we do see that haven demand continue within the market.
Yeah, and as I say, if the euro mess is going to continue these elections, then that should keep the pressure on the pair as well.
Indeed. Well, the euro is always a mess, but more of a mess than normal at the moment. Right, moving on. I want to look at something that is a little bit geeky, if I'm being completely honest, but it's something that's caught my eye. It's not necessarily a tradable setup, but what we're looking at here is the usage of the BOE's short-term repo facility. Now, what the hell does that mean, I hear you ask? Essentially, in layman's terms, it is a facility where banks within the UK can swap gilts for cash. Is the pretty much the simplest explanation of it. And usage of this facility has, as you can see on the chart, gone through the roof recently. We've had 8 straight weeks of record demand at the BOE's weekly repurchase operations. And what does that mean? Well, it's a clear sign that there is that a shortage of cash is beginning to develop within the UK money markets and within the financial system, because banks are swapping those gilts for cash in increasing amounts. Now, firstly, why should we care? And secondly, why is this a thing? Well, why should we care? Because it's quite clear that there are funding stresses beginning to emerge within the financial system here in the UK. Repo rates are also rising, so the banks are paying more for the privilege of doing this as well. And why is this happening? Well, it's likely a result of the BOE's continuing quantitative tightening program. Now, what pretty much every other central bank around the world is doing to run down their balance sheet is simply letting the bonds they hold on that balance sheet mature, and then not reinvesting the proceeds, not buying any new securities to keep the balance sheet at the same level. The BOE are going one step further. Yes, they're doing that, but they're also actively selling some of the gilts that they hold on their balance sheet as well, to try and get it down to a smaller size much, much quicker than their G10 central bank peers. And it seems that that is having quite a pronounced effect on financial markets here in the UK. And there is certainly no sign of this demand for the repo facility slowing down anytime soon. Now, what does this mean? Well, the BOE handily review their balance sheet operations once a year every September. And I think as repo usage continues to increase, it really does become increasingly likely that the BOE are going to stop these outright and active gilt sales at that annual review in around about 3 months' time. And the implication of that, well, perhaps it's going to relieve some of the pressure that we've seen on gilts this year, which have actually underperformed relatively significantly. So a little bit of a nerdy one, but one that I think is pretty important, and one that I would argue is probably not getting as much attention as it really deserves at this stage.
Yeah, it's an important pickup you've made there, mate. And I'm wondering if that's something that's going to feature at the Bank of England meeting. Are they going to touch on it? Is that going to be a reason? Maybe why, because some people in the market can call it easing if they stop doing QT, or if they've reduced how much they're selling. That can be seen as a bit of an easing measure. So maybe that's something that does prop up. The market's not expecting that they slow that down in an effort to get back on the easing path or to get things back to normal. I don't know, maybe there's some election vibes in there as well. Maybe it's just Bailey, getting some cash ready to go on holiday when they shut down for the summer. Who knows with those guys? But I don't know the ramifications myself if this keeps going. But I think you're right. It is something that the Bank of England will pick up on. So we should maybe prepare to hear a couple of comments this week.
Yes, indeed. If they are going to pick up on it this week, then it would be in the minutes that accompany the policy decision. That's where it would likely feature. And of course, the minutes, be they BOE minutes, FOMC minutes, whoever, they are a deliberate document. Policymakers are putting in there what they want to signal to the financial markets. There is a reason why comments that appear in central bank meeting minutes are in that document. It's not by accident. So, yeah, that's a very, very good point. Do obviously keep an eye out for mention of that in the minutes accompanying Thursday's decision. In any case, lastly, we're going to have a look at the commodity space.
Yeah, going to take a look at copper and what's been going on in there. It's the recent big rally has come as stories of anticipated shortages were circulating in the market. But as with all commodities, the demand picture needs to be strong too to keep prices supported also. One of the big players in this one is obviously China, who's really a big inventory builder. But their dynamics have slightly changed this year. Usually China stockpiles early in the year and then draws down those inventories over the rest of the year. However, with one of their big domestic markets being the property sector in heaps of trouble, it looks like while they've continued to increase stocks, the demand side for that has been weak, particularly, as I say, from the housing sector. Now, in other parts of the world, and if you take something like the PMIs, manufacturing, the numbers there, we've seen, as I said earlier, contraction in really nearly everywhere for several months now. And although there's been slight improvements in some of these numbers, the numbers still have remained in contraction. So the demand side of things has really been a messy affair for this. So whatever factors are at play at the moment in copper, the price really speaks for itself, and it's continued to head lower after that high point. We're through the 50% fib of the Feb rally, but we're holding the 2023 high that was broken this year around the $4.36 mark. Below there and near to the 61.8 fib at 422, we have former highs from February to April 2023. They're around 419, so that's a bit of a support area down there. Now, with the flash PMIs kicking off on Friday, some good reads from the manufacturing sector there could start to underpin copper, and we see a bit of a bottom forming. If we do get a bounce from any of these levels down here, it's going to look like we might have, as I say, found a bit of a bottom, temporary or otherwise. But if the data comes in weak, we could be heading further down towards that $4 mark. So either way, if you don't trade copper, if you don't trade any of these commodities, you need to keep an eye on these for implications for FX and other assets. For example, copper's a very heavy correlated currency with something like the Aussie dollar. So it's very important that you monitor these charts as well. But we've had a big drop. The question is, can it continue or not?
Yes, absolutely. I think that's a very, very important point. You do need to bear in mind the correlations that these things do have with other assets. I just want to say I'm pleased you managed to get through that segment without calling it Dr. Copper, because that is one of my financial market pet peeves, and I might have had to ban you from the show if you did that.
Well, I might be banning you from the show when I've just to keep an eye on your next subject that's coming up. So, yeah, don't talk too soon, mate.
I'm not sure what I've done now, but let's move on to that next subject and find out why I'm being thrown off my own show. Well, here goes then. Potentially my last ever appearance on the trade-off with my last ever play of the day, depending on what Ryan says next. I want to look at French equities this week. Of course, markets are infamously bad at pricing political risk, as I mentioned a moment ago, and this seems to be another classic case of that, with the CAC down well over 10% from those highs that we saw towards the middle of May, as the market's been really caught off guard by this snap election call within France. Of course, the other thing to mention is not only are markets bad at pricing political risk, the CAC has, in a similar way to the FTSE 100, almost nothing to do with France. Probably about 40 or 50% of the index is, in terms of listed shares, is owned by overseas investors. The other thing is the revenue split. Only about 15% of revenue from firms within the index actually comes from within France. So, of course, they are two things that are worth bearing in mind. Nevertheless, I am not one to be wanting to catch a falling knife, and I wonder whether that cliche is what he's going to moan at me about. But I do remain bullish on risk more broadly. And I think over the medium to longer term, this sort of a decline could actually present a relatively good buying opportunity. Now, of course, we are below all three of those key moving averages, so I would be looking for the market to build a little bit of a base before starting to nibble in with a few longs around 7,500 or even this 7,400 level, which was resistance through the early part of 2023 and then turned support. If we hold either of those levels, then this is something that I would be looking to get long and buy that dip once things may have stabilized a little bit more. Ryan, Euro Sterling.
Yep, Euro Sterling for me. I'm looking at maybe a bit of a Bank of England play here. And this pair's a big favourite of mine, and I finally got put out of my 2-year strategy of longs by playing off the 85 level when we broke down over the EU election news last week. And I've been neutral since, but I do fancy a bit of a BOE play on this one. Now, as I mentioned, if CPI data is on or lower than expected, it's going to be a close run thing as to whether the Bank of England cut this week, and far closer than the market is expecting. So I'm looking at getting long for that data to run it into the Bank of England. If the data comes in slightly hotter, we'll see Euro Sterling moving lower, but that likely means that the Bank of England won't cut, but at the least they should signal a potential August cut. So that's going to keep the drop or sterling gaining pretty limited, in my opinion. And as I say, they'll probably likely do that via the votes. So with confirmation of the 84 figure at the moment as decent support, we've had one test down there, backed up with a move back above my zone that you can see on the chart there. I'll use that level really to define my risk. It makes it a pretty good, nice tight trade down there, whatever happens. So I'm looking at Euro Sterling longs for this week.
Good stuff. I've got to say, it's probably been about a decade or so since the sterling side of this one represented relative political stability. So it's certainly nice that has been flipped on its head. In any case, that does bring us to the end of another show. Thank you very much, as always, for watching. Thank you also to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Plenty for markets to get their teeth into this week, even if the data docket is a little bit quieter. If you have enjoyed the show, then please drop a like, leave a comment as well. Let us know how you're trading the markets, or if there's anything you'd like us to discuss next week. And that is indeed when we'll be back with another episode of The Trade-Off. Until then, have a very good week ahead, and we will speak to you next week. Thanks as always for watching. Goodbye.